60,000 plus crore rupee order book, monopoly-like positioning, government-backed demand tailwinds. But is Bharat Electronics Limited still undervalued or already priced for perfection? Welcome to the breakdown of BEL's FY26 performance. In the next 10 minutes, we go beyond headline numbers to uncover the real drivers of its growth, the strength of its competitive moat, and the key catalysts that could shape its future. To fully evaluate BEL's performance, we are using a comprehensive four-part analytical framework. First, we look at the hook, which is the sheer scale of the operation, unpacking the massive fiscal year 2026 revenue surge and record-breaking margin expansion. Second is the engine, analyzing the growth engine, powered by a 73,800 crore rupee order book and structural defense indigenization drivers. Third is the foundation, where we stress test the quality of the business by looking at its pristine zero-debt balance sheet and cash flow conversion metrics. Finally, we do a reality check on the core risks, providing a balanced look at structural tailwinds versus critical geopolitical and strategic supply chain dependencies.
Let us dive straight into the executive KPI dashboard for fiscal year 2026, which highlights a stellar year of execution. Revenue came in at 27,479.63 crore rupees, representing a robust 11.60% year-over-year growth that was driven entirely by core defense electronics execution. Profit after tax crossed a historic milestone, surging 14.38% year-over-year to reach 6,048.48 crore rupees, proving that the company's profitability is highly structural. At the same time, the consolidated EBITDA margin expanded from 29% in the previous fiscal year to a remarkable 30.0%, unlocking massive manufacturing efficiencies. This performance is backed by a monumental total order book of 73,882 crore rupees, which includes over 30,045 crore rupees in brand new order inflows, giving the company exceptional multi-year revenue visibility.
Looking closely at the standalone profit and loss statement, we see a massive execution surge in the fourth quarter. Total income for the full fiscal year reached 28,070.02 crore rupees, an increase of 10.43% year-over-year, showing that core execution is driving expansion, even with lower treasury yields. Material costs scaled linearly to 13,979.32 crore rupees, up 11.13% year-over-year, with semiconductor components accounting for 17 to 19% of these costs. A beautiful chart comparing the final quarters shows a staggering 42.90% quarter-over-quarter surge in execution due to back-ended government seasonality, with revenue jumping from 7,121 crore rupees in quarter 3 to 10,177 crore rupees in quarter 4. This outstanding execution pushed undiluted earnings per share up significantly to 6 rupees and 27 paisa, compared to 7 rupees and 23 paisa in fiscal year 2025. The real magic behind BEL's premium 48.17% fourth quarter gross margin lies in its powerful defense indigenization flywheel. This structural catalyst begins with local sourcing and in-house intellectual property engineering, which creates an incredible 80 to 85% indigenous product mix. This high level of indigenization drives premium gross margins, expanding the company's consolidated performance to a 30% EBITDA margin. These premium margins then generate massive internal accruals, leading to the record-breaking profit after tax of 6,048 crore rupees. Finally, these internal accruals are pumped right back into the business, fully funding zero-debt research and development alongside major capital expenditures, including over 1,200 crore rupees dedicated to advanced grid upgrades, restarting the virtuous growth cycle all over again.
Let us visualize the massive revenue moat protecting this business. A towering 73,882 crore rupee order backlog. When we break down this large tree map of contracts, we see a highly diversified mix of high-value sovereign projects. Electronic fuses represent approximately 4,300 crore rupees. LRSAM systems take up around 3,500 crore rupees, and LCA Tejas LRUs secure 2 separate allocations of approximately 3,200 crore rupees each. Additionally, BMP-2 upgrades account for around 2,800 crore rupees, the Ashwini radar commands approximately 2,460 crore rupees, and Mi-17 EW suites make up about 2,200 crore rupees. This total backlog gives the company unmatched business visibility, sitting at an equivalent of nearly 2.7 times its standalone annual revenue, completely secured by long-term, multi-year sovereign contracts.
Shifting our focus to the capital structure, BEL presents a pristine, bulletproof balance sheet that is an absolute green flag for institutional investors. Long-term debt is completely nil, showing zero leverage across the business. The entire capital base expanded by over 20% to 23,697 crore rupees, built solely via internal accruals without borrowing a single rupee. Looking at cash fortitude, the company holds a massive net cash surplus of 8,418.67 crore rupees. Cash reserves grew by a spectacular 168% year-over-year to 1,826.93 crore rupees, accompanied by 6,591.74 crore rupees safely stored in optimized term deposits. In terms of short-term defense, the current ratio strengthened from 1.76 times to 1.97 times, providing a massive defensive cushion against any unexpected supply chain or geopolitical disruptions.
Now, let us map the cash conversion pathway to see how efficiently operating profits translate into real cash in the bank. The company started with a strong standalone operating profit of 8,060.61 crore rupees. Working capital changes led to an outflow of 4,547.60 crore rupees, reflecting a typical seasonal spike in trade receivables due to back-ended year-end customer billing cycles. After accounting for 2,018.67 crore rupees in taxes paid, the cash flow from operations landed at a solid 1,494.33 crore rupees. This is a massive jump from the 457.25 crore rupees reported in fiscal year 2025, bringing the CFO to PAT conversion rate to 24.7%. Deducting 983.12 crore rupees in necessary capital expenditures leaves a highly positive net free cash flow of 511.22 crore rupees.
While the standalone books drive the core engine, BEL houses specialized tactical operations that generate highly value-accretive alpha under equity accounting. Its strategic subsidiaries include a 100% holding in BEL Optronic Devices and a 74% stake in BEL Thales Systems. On the associate side, it maintains a 26% interest in GEBE Private Limited. Together, these specialized entities command a combined asset base of 522.14 crore rupees and generated 269.96 crore rupees in operational revenue during the year. This translated into a high-quality net profit after tax of 40.00 crore rupees, which was directly injected back into the consolidated bottom line.
Looking ahead, management's forward outlook and official guidance for fiscal year 2027 project aggressive structural growth fueled by imminent big-ticket project wins. For target number 1, revenue scale, management is projecting a growth rate of over 15%, driven by the sustained expansion of core defense execution. For target number 2, profitability, they are guiding for a sustainable EBITDA margin of over 28%, with margin resilience heavily protected by their local sourcing capabilities. Finally, for target number 3, new order inflows, management is targeting over 55,000 crore rupees, bolstered by massive pipeline catalysts like the imminent QRSM project slated for the first or second quarter of fiscal year 2027, alongside the next-gen Corvettes contract.
To maintain an institutional perspective, we must evaluate the structural positives against strategic risks using a balanced matrix. On the positive side, secular tailwinds position BEL as the premier defense electronics provider with a highly optimized 80 to 85% indigenous product mix. Its capital allocation is stellar, using a zero-debt balance sheet to fund a massive 1,200 crore rupee plus high-performance computing and artificial intelligence capability upgrade. Furthermore, pipeline catalysts are in advanced stages for the QR-SAM project and critical submarine subsystems. On the flip side, strategic risks include heavy customer concentration, as revenue is highly dependent on the Indian Ministry of Defense's capital allocation budgets. Working capital is also highly susceptible to inventory buildups and back-ended government payment cycles. Lastly, there are geopolitical dependencies, as high-end semiconductor imports from the US, Europe, and Taiwan still make up 17 to 19% of total raw material costs.
To round out our evaluation, let us run through a quick corporate health diagnostic to check for common financial red flags. Is there a structural profit versus cash flow variance? No, this is cleared, as the higher year-end trade receivables were fully collected shortly after the close of the fiscal year in April and May. Is there a reliance on volatile, one-off transactions? No, the performance was driven entirely by core operational lines. Has there been any deterioration in leverage? No, the company maintains its pristine, zero-debt balance sheet. Did we see any unexpected margin contraction? No, full-year EBITDA margins actually expanded to 30%. Lastly, is management engaged in aggressive, unproductive CapEx? No, all capital expenditures are strictly targeted at advanced future capabilities, such as directed energy weapons and AI computing.
Our final verdict on Bharat Electronics Limited is structurally constructive. The company's exceptional operational execution fully supports its premium valuation multiples relative to historical averages. This premium is fundamentally justified by three rock-solid pillars: massive multi-year revenue visibility via its 73.8 thousand crore rupee backlog, a structural margin moat built on over 80% component indigenization, and exceptional capital hygiene, characterized by zero debt and an enormous 8.4 thousand crore rupee net cash surplus.
Make sure to screenshot this slide for a summary of the core institutional takeaways. We have seen record top and bottom line growth, with revenue up 11.6% and net profit up 14.3% year over year. The 73,882 crore rupee order book provides an impenetrable multi-year revenue moat. Profitability remains highly structural, driven by a reliable 30% EBITDA margin and relentless local sourcing. Finally, the balance sheet is virtually bulletproof, with zero debt, a massive 8.4 thousand crore rupee net surplus, and fully funded R&D.
Now we want to hear from you. What is your personal verdict on BEL? Do you think their secular defense tailwinds and massive order backlog completely outweigh the high-end semiconductor supply chain risks? Drop your investment thesis in the comments below. And if you found this Bharat Electronics earnings deep dive helpful, don't forget to like, save, and share this video. Follow and subscribe to ZinvestZ for more smart investing insights. Thanks for tuning in.